Imagine this. There's a pie out for sale baked by an old sweet grandma. This is a special pie though. It can grow or shrink based off multiple factors that aren't important right now. Only portions of this pie are sold, not the whole thing. Now, someone comes along and notices the pie. Thinking it's good and has the potential to grow, that individual buys a slice of the pie from the grandma and now owns that slice. That portion of the pie is theirs. He or she can keep it for as long as they want. Now, some time goes on and the person's assumption was right. The pie grew bigger. Now the person goes back to the grandma and sells his or her portion back to her, in which the grandma pays them back how much they bought it for plus how much the pie grew by. So the person got back what they put in and then some more, a profit. This is a very basic analogy of how the stock market works. The pie is a company, slices are shares of that company, the grandma is the owner, and the buyer is an investor. These things from the basics of the stock market. The stock market is always changing and ultimately controls the economy, and anyone of age is able to trade on it. It's a rather simple and very smart way to invest money. Not being on the stock market excludes one from the chance of a big profit. Even the SEC, Securities and Exchange Committee, the government branch that manages the market, agrees. Written on a post about the concepts of stocks, it reads, "Stocks offer investors the greatest potential for growth, capital appreciation over the long haul." So it's easy to see why many people are hopping on the stock market train. The market has three main elements, which I will do my best to explain. They are the buyers/investors who purchase the stocks, the sellers or companies selling the stocks, and the actual price of the stock, that is, how the price fluctuates. So to begin, what is a stock? A stock is a share in ownership of a company. These stocks are available for anyone to buy as long as the company is publicly trading. Investors or buyers are the people who purchase the stocks. These investors go into the stock market hoping to make a profit. As Steven Melendez puts it, investors often buy stocks in hope that it will rise in value so that they can sell it later at a profit. Melendez implies that investors try to go through what is the key element of being an investor, the buy low, sell high route, which is easy enough to understand. You want to purchase a stock at a low price and sell it when it gets high. This simple idea of investing is the most beneficial way to make money in the market. It sounds easy in practice, but executing it is difficult. The most common way to buy a stock is through a stockbroker. A very popular broker currently is Robinhood. That's because it's free, and most require trading commission, which is a fee to continue using their services. However, no matter what broker, they are generally the same. They will show information about stocks currently owned, news about companies, and a portfolio that shows daily, weekly, and hourly changes of all stocks or your stocks. In addition to buyers, their counterparts, sellers, are just as important. Sellers are really the companies as corporations selling their shares. Any corporation can enter the public market, but to do so, they must become an IPO, initial public offering, and must go through the SEC in order to legally go public and sell their stocks. Metcalf breaks down how companies do this by saying, when a firm decides to pursue an IPO, it hires an investment banker to handle the offerings, lawyers file documents with the SEC, and brokers begin to gather indications of interest. When all the legal issues are settled, the company goes public and stock trades for anyone to buy or sell. Now, why would a company want to sell the stocks to the public? The biggest and most common reason why is so the company can easily make money with no extra fees or conditions. Some companies, such as In-N-Out, for example, choose not to enter the stock market and remain private. Therefore, they are not subject to the SEC rules and can make their own guidelines. Finally, how does a stock change price? Ultimately, it comes down to supply and demand. If there is a stock wanted by a lot of people, but there's a limited amount, the price goes up. Similarly, if there's a lot of stock, but not many people want it, the price goes down. It sounds simple, but as the article, What Causes Stock Prices to Change, says, understanding supply and demand is easy. What is difficult to comprehend is what makes people like a particular stock and dislike another. This comes down to figuring out what news is positive for a company and what news is negative, which leads to the next possible change of price. News from the company always impacts their value, whether it's good or bad. For example, in 2019, when Apple launched their new TV subscription, Apple TV Plus, they saw a significant jump within their stocks. However, whatever happens to the price of a stock, it alone does not determine the value or worth of a company. What really determines that is market capitalization, which is the price of the stock times the total amount of stocks. All in all, the stock market is a powerful tool that controls our economy. From investors to buyers to prices of stocks, it's easy to be intimidated by it all and just bother to not deal with it. However, though it can be complicated and very tedious, the benefits of learning the market can reward an individual greatly. If one puts in the time and effort to learn about the market and all its components, one will have a very good chance at making profit. So just remember, buy a slice of a pie that will grow. Thank you.